You see this right here? You can say more of these coming up really soon, and at the same time, it's not be worth as much, so goodbye. Heard recently, the Federal Reserve decided to pause interest rates, and is steadily doing it during the January meeting. Maintain the federal funds rate within the range of 5.25% to 5.5%. Now, this marks the fifth instance in 6 meetings where the rates remain unchanged, despite 11 rate hikes during the current economic cycle to curb high inflation. As I shown earlier, that $100 bill, more of them's gonna be coming in, and at the same time, higher inflation. So, inflation peaked over 9% in mid-2022, but eased to 3.4% year over year by December. The Fed's latest rate hike occurred in July 2023. Consumers can anticipate a rate decline despite a single hike in the past 6 meetings and the Fed's indication of potential rate cuts in December of this year. So now you gotta ask yourself, what does this mean for saving accounts and, let's say, CDs in this case? This pause means that many banks also pause changing their rates on savings, CDs, and money market accounts. Now, while others have actively pared them back in anticipation for the Fed's lowering rates in the future, which is predicted to be in mid-2024 from major institutions. Now, most likely, the federal government will not go against the major institutions because a lot of people like us are watching. So, if savers are looking to maximize their earnings from interest, they should consider turning to online banks or top credit unions in this case, where rates are typically better than those of traditional banks. But you gotta ask yourself, however, when it comes down to CDs, account holders who recently locked in rates should retain those yields for the term unless they are willing to pay the penalty. But now, what does that mean for mortgages in this case? So while it does not affect mortgages, if high inflation continues to ease, home loan rates will likely soon follow in this case. You should carefully consider taking on any additional debt as interest rates remain elevated. If interest rates decrease and let's say you have a chance to refinance, then it will be a pleasant financial surprise for your budget. Because if you refinance, then you can lower your interest rates and lock it in. There's a reason why like a lot of people sold their homes and they couldn't get back in, or they did get back in now to pay a higher interest rate because they want to keep that fixed interest rates before the rate hikes. Now, in this case, as for loans, interest rates on personal loans have risen from 8.73% at the beginning rate hikes in 2022 to 12.35% in November 2023. Now, student loans, once again, are a top priority and a concern for those who are still making payments, and luckily, the federal loans have fixed interest rates in this case. Now, going down to credit card interest rates have moved from an average of 16.65% to well over 22% during the latest rate rising cycle. Now, without doubt, those variable APR interest rate charges on credit cards will still remain high. Do prioritize paying off the credit cards as soon as you can, especially the ones with high interest rate charges. With minimum payments due won't ease off, along with stiff interest rate charges on credit card balances will remain unless you pay it off each billing cycle, because credit cards are crooks at the end. They're there to make your money for using their product or service. Now, when interest rates are low, stocks tend to perform well because they are seen as better investments than bonds, with expectations of lower rates and a decrease in the 10-year treasury yield. Investors are more excited about stocks likely. Since 2022, raising rates have hurt bonds, especially those of larger maturities. Now, with a pause in rate increases and anticipation of rate cuts, new bond investors are feeling optimistic, leading to a rally in the bond market since of October of last year. Now, as rates drop again, bond investors will benefit from higher bond prices. Now, ask yourself, however, with the economy not yet experiencing a recession, stock investors may face a bumpy ride in this case. Now, in the meantime, short-term rates may remain attractive to those seeking a safe place to hold their money until things settle down. So considering the current trends in interest rates and market behavior, it might be wise to focus on short-term investments or safe options while awaiting more stability in the stock market. Now, you gotta ask yourself, despite the recent high inflation, the Fed has chosen to keep rates stable. Now, savvy consumers, like majority of the people, can benefit by carefully seeking higher rates on savings accounts or CDs. This could also be a really great opportunity for you guys to secure long-term CD rates or consider balance transfer credit cards in this case. So with stable interest rates amid cooling inflation, it's a strategic move for consumers like you and me, the average person, to explore options like seeking higher rates on savings or CDs in this case, and considering long-term CD rates or balance transfer credit cards. Now, personally, my opinion on this, with them pausing interest rates, I consider it too soon. The reason why I say it's too soon, they look at inflation. As I mentioned before, they calculate inflation based on their PCE inflation report. and it shows it's going down, but they minus like certain key parts like food and electricity. Does it include everything else, like for example jobs and wages, the price of goods and services, what type of categories? I feel like they're doing a little bit too soon, but let's see what they do. They're gonna pause it, and they're assuming that majority of people, institutions say they're gonna decrease it during around the mid of this year, around maybe summertime. And a lot of people are saying that this is a bit too early. And of course, when you lower interest rates, people will start purchasing things again. When they start buying things again, inflation will go up because there's not enough supply. Personally, I think this is the case, and with some institutions, they do agree with this. Now, what do you think down below? Do you think they are pausing interest rates a bit too early? Do you think they're going to lowering interest rates by enough this year? Is it still too early? Should it wait to 2025? Make sure you comment down below. Hit the subscribe button. And I'll see you guys next time. Have a wonderful day. And I'll keep you guys updated when the next pause happen. Apparently next month. And they're going to pause it maybe until around maybe April to May. And they might start dropping. Subscribe. I'll see you guys next time.